Our presenters today will be myself, Chris Laughton, Director of Knowledge Exchange, as well as Bill Zweigbaum, a business consultant with Farm Credit East. This is not intended to be legal, financial, or tax advice and should not be relied on by recipients for such purposes. The information here is presented in good faith and believed to be accurate. However, we cannot be liable for decisions made or actions taken based on what we present today. Bill Zweigbaum will be presenting after me. I will be giving an overview of the 2019 Northeast Dairy Farm Summary, which is a review of the economic conditions of the Northeast dairy industry in New York, New England. Bill Zweigbaum will then follow me and give a mid-year outlook for the dairy industry in the Northeast. So, as I said, I will present a review of the 2019 financial results of the Northeast Dairy Farm Summary. Following that, Bill Zweigbaum will present his mid-year dairy outlook, and then we'll have time for some audience Q&A. The full report that I'm going to cover, that I'm going to talk about today, is available at farmcrediteast.com/reports. So, some key points about the Northeast Dairy Farm Summary. Normally, this report comes out in May every year. This year, it was delayed due to the COVID-19 situation. Because of the postponement of the tax filing date, as well as some of the disruptions that farms had to deal with, many farms did not have their financial information ready at the time that we would normally want to get it. So we postponed the collection of data for the report. We fully intend to return to the previous timeline in subsequent years. But for this year, we had to delay it until now. We had 267 dairy farms, mostly from New York, that participated. This makes for a remarkably robust analysis of the Northeast dairy industry. Having such a large number of farms in the study allows us to analyze the data in a number of different ways, and it reduces the chances of having the numbers skewed by outliers within the industry. So we really appreciate the industry support that makes this analysis possible, particularly in a year like this one, which had many difficulties. It's also a testament to the large number of Farm Credit East staff who work on this project, compiling the data from all these farms and getting it into our system in a timely fashion. We've been doing this report in a pretty consistent fashion for 40 years now, which makes it a valuable resource for research. And many universities have used it in doing published papers on the Northeast dairy industry. It's worth noting that our sample skews somewhat larger than the average dairy farm for the region and probably more profitable than the true average for dairy farms within the Northeast region. The USDA Ag Census tells us that there are a very large number of small dairy farms in the region and that the average herd size is about 135 cows. Our sample in the Dairy Farm Summary group of farms was 600 cows, milking cows, which is obviously significantly larger than the true average for the entire region. However, we do break down our results into 4 size categories: 0 to under 100 cows, 100 to 299, 300 to 699, and 700 or more, so that readers can see data for the size group they're interested in. Profitability in 2019 increased pretty significantly from the prior year. Our average farm in 2018 lost $40 per head. In 2019, the average farm had positive net earnings of $447 per cow. This was largely a result of the 2019 milk price of $19.18, which was almost $2 higher than the previous year's price of $17.19. Net cost of production was kept fairly consistent with the prior year. It was only 9 cents higher and came in at $17.81. And how we get to that number, I will describe a little in more detail later in my presentation. Total debt per cow declined slightly, mostly because we had a bigger herd sample, so the debt per cow was spread out among more cows, but it remains high and it's still north of $4,000 per cow, and I'll talk more about the significance of that as well. So farm milk prices per hundredweight, we can see that there's been significant volatility over past years. This shows the milk price average for the year since 2000, as well as the 5-year rolling average. We can see the peak in 2014 and the pretty significant decline in the following 5 years. Prices have bounced up and down a little, with 2019 representing a 5-year high. But when you look at the 2019 data point on the very right-hand side of your screen here, you can see that it's still far below previous peaks. So it was a good year, but it was certainly not a great year. This chart shows net earnings per cow, with the blue line marking the break-even point. We can see that they have also fluctuated wildly over the years, mainly driven by wholesale milk prices. You can see the peaks in previous years, but in general, we seem to often return to that break-even point, which is, as I said, the blue line in the center of the chart. One reason for this is that when earnings are high, producers nationally and globally tend to increase production, which often shifts the balance of supply and demand and results in lower prices after that. With the trend line, we can see that despite significant volatility and 1 year of major losses in 2009, the overall trend of net earnings has been positive. Some have suggested that the volatility has actually been something of a plus in some respects, and has helped boost average net earnings over time for those who can stomach the roller coaster ride. However, the last 5 years have been somewhat different. 2015 through 2018 showed earnings significantly below that trend line, which raises the question of whether that trend's really going to continue, or whether we're in a sort of new reversion to the mean of break-even to modest earnings. 2019 is the only recent year to show earnings above that trend, and then only marginally. So that trend line does show that volatility has led to some peaks that have given us relatively good earning years, but recent years have called that trend into question and whether it's going to continue. I mentioned cost of production at the beginning of the presentation, and this chart shows the net cost of production and how we calculate it for a number of years. Basically what we take is we take cash expenses, so that's what farms actually spent per hundredweight. You know, we take the total expenditures of the farms and divide it by the hundredweights of milk produced. We add in depreciation to capture that non-cash expense. We add in family living as well, and we come up with a number that represents the total cost. Some analysts report this as cost of production. We go a little further. We subtract non-milk income. This doesn't include things like an off-farm job. We refer to that as non-farm income. But non-milk income does include things like crop and livestock sales, as well as ancillary revenues that are tied to the business, such as maple sugaring or other affiliated business ventures. The result then is net cost of production. It's worth noting that the steady decrease in depreciation, family living, and non-milk income are in large part due to the increase in average herd size of our sample over the past several years. For example, in depreciation, which is considered a fixed cost, the more production you have, the more that value gets diluted and becomes smaller. So some of what you're seeing here in the decline of cost of production is a result of economies of scale as farms have gotten bigger. Some of it also is a function of milk prices falling. For example, in 2014, cost of production was fairly high. Some of that was due to farms spending more money, not necessarily in a frivolous way, but catching up on deferred maintenance, perhaps paying their employees a little bit, and reinvesting in the business, that sort of thing. In subsequent years, when milk price has really fallen, there's a tendency, if you don't have it, you don't spend it. So cash expenses normally fall when milk prices fall, because the farms simply don't have the cash to spend. So that's another driver of the net cost of production falling. It's also worth noting too that these numbers are not adjusted for inflation. So this falling of net cost of production that we see here is against a backdrop of modest but fairly steady inflation of a couple percent a year. So while background prices in the general economy have increased, farms have managed to keep a lid on expenses through a combination of frugality and efficiency. So when we talk about net cost of production, we often speak of it as one number. And I get inquiries from researchers and others, oftentimes asking what the cost of production is of our study, or debating whether it's the right number or that sort of thing. But really, it's important to note that each farm has its own unique cost of production based on the individual characteristics and cost structure of that farm. So this pattern of net cost of production distribution roughly follows what statisticians would call a normal distribution, or a bell-shaped curve, where we have a cluster around the average and then tails of outliers on each side. So we have a peak around that $17.50 to $18.50 range per hundredweight. And then, of course, there are farms that have higher cost of production than that, and farms that have lower cost of production than that. In this chart, farms on the left-hand side of the screen have lower cost of production and therefore are likely to have higher earnings, while those on the right-hand side have higher cost of production and are likely to have lower or even negative earnings. Farms that are on the extreme right-hand side of the chart that have very high net cost of production, well over the milk price received, will struggle, and some of them may exit the industry if they're unable to adjust their cost structure or business model within a fairly short period of time. So another thing to look at is the net cost of production by region. This shows net cost of production for New York and the New England states in 2018 and 2019. And we can see a few things. One is that New England farms generally have higher costs than their counterparts in New York, and that's true even when we adjust for size differences of the farms. Some of the line items more costly in New England include purchase feed and labor. Non-milk income is generally lower as well, which is again subtracted from total cost to get net cost of production. And one reason for that is because New England farms tend to have fewer acres per cow than farms in New York, so therefore they tend to have lower sales of surplus crops, which is a rather significant income item for farms in New York State. So similarly to having a range of cost of production, we had a range of earnings. So this slide shows some of the range of farm earnings for 2019. While the average farm had $447 in profits per cow last year, the bottom quartile of farms sorted by profit had losses of minus $359 per cow. That translates to a loss of over $125,000 per farm. The top profit quartile, in contrast, had a very good year with nearly $1,000 in net earnings per cow. So while it may seem obvious, positive net earnings are essential for a farm to remain viable and sustainable economically. While the average farm had about $270,000 in net income last year, that doesn't mean that they got to put all that in their pocket, so to speak. Those net earnings are needed to cover debt payments. Remember that while interest paid on debt is a business expense, principal payments have to come out of earnings. So and earnings are also required for reinvestment in the business, capital improvements, as well as things like contributions to retirement savings and cash reserves. And as you'll see later in the presentation in a couple of slides, we're coming off of 4 years of 4 really rather lean years. So this year of positive net earnings is really a welcome respite and a chance to come up for some air from the previous years when farms have really struggled with cash flow. So similarly to the distribution of cost of production, we have a similar distribution of net earnings. Here we can see on the left-hand side of the screen farms that had low or negative net earnings, and then those on the right-hand tail had better than average earnings. So this just shows that even in a relatively good year, such as 2019, there are a number of farms that still struggled to earn money or even break even. And again, those farms on the left-hand side of the chart are vulnerable to having to exit the industry or make some other drastic changes if they're unable to adjust their business models or cost structures fairly quickly. So if you're a producer and find yourself on the wrong side of break even in a relatively good year such as 2019, you may want to consider retaining the services of a consultant to help make the needed adjustments to put your business back on track. Farm Credit East has a number of experienced and highly knowledgeable consultants that specialize in the dairy industry, who may be able to assist. So this chart looks at accrual earnings over time. So accrual earnings is basically just a fancy accounting term that means it includes all expenses incurred and all revenue incurred in the year, regardless of whether cash actually changed hands. So it includes non-cash things like depreciation and inventory changes. And note that it does not include debt principal payments. Those would have to come out of earnings. So you'll notice the fairly steady decrease in costs over time, which, as we said, is influenced by the increasing size of the farms in our sample and subsequent economies of scale. We can see also that we had a pretty robust year in 2014 with strong earnings. Then we reverted to a year of losses in 15, basically break even in 16, 17 very modest earnings, 18 down to a loss again, and then 19 showed a little bit better positive net earnings, but of course nothing like what we saw in 2014 or some previous peaks. Moving on to cash flow, which is equally important as accrual profits. Cash flow is basically how the farms pay their bills. It does not account for non-cash items like depreciation, which is the rate, of course, at which your equipment is wearing out, but it does cover all debt service, including principal payments. So we can see that in every year other than 2014 in the past, the cash required of milk, the cash required per hundredweight of milk produced exceeded the price paid for that milk. Farms rely on that other income line item to reach their break-even point. Again, this includes things like crop and livestock sales, as well as, for some farms, particularly smaller ones, revenue from those ancillary business activities like custom work, maple sugaring, or other activities. So what that basically is telling us is that producing milk alone is not enough to be profitable. You need that other income from things like livestock sales of cull cows, perhaps some ancillary business activities, and then perhaps crop sales. So when we look at the fact that farms really haven't had any extra cash at all for 4 years in a row, 2019 was really a chance to gasp for some air for a lot of farms and hopefully restore some of their cash position. Here's just a graphical indication of that same chart going back a little bit earlier, going back all the way to 2011. But it showed that we had some pretty strong years leading up to 2014, and then really a stretch of lean years, of which 2019 is the first break in that trend. And even then, it's good but not great. So 2019, I take it as a positive development. Definitely not a windfall year, but hopefully a trend that we'll see continue into the future. And Bill Z will talk about what the future may bring. But it's hopefully a chance to return to some positive earnings. So how have farms made ends meet during these lean years? Well, one way is through increased borrowing. So this chart shows the average total liabilities per cow of the farms in our sample over the last 40 years. So this is going all the way back to 1979. And total liabilities per cow includes not just bank loans, but things like trade credit, all liabilities that the farm has. And it's per cow, not per farm, so that allows us to get past the increase in farm size that we've seen over the years. So it's normalized for farm size by dividing against the number of cows. One thing that's notable in this chart is that it took 29 years, it took 29 years for the average debt per cow to climb from $2,000 to $3,000, but only 8 years to subsequently break $4,000. Now, there is, of course, some impact from inflation over this period, which we'll look at in a moment, but it's still a noteworthy shift in the amount of leverage that farms are carrying. And that has several implications, which I'll talk about in a minute. So if we add in an inflation-adjusted line, which is blue in this chart, you can see that farms have had this kind of high leverage before, but we have to go all the way back to the 1980s to get there. So to sort of summarize, I don't think we're at a crisis point or anything in terms of dairy farm debt, at least not on average. But increasing leverage does limit the flexibility of farms in some ways and can make price volatility harder to take because those debt payments don't go away when the milk price drops and we have a lean year. Often that lean year is accompanied by increased borrowing to make up for operational losses, which drives that average liabilities figure even higher. So another way to look at farms' financial position is their liquidity. There are two commonly used measures that I present here, the current ratio and the quick ratio. The current ratio is simply current assets divided by current liabilities. Current assets are those assets which are cash or expected to be converted to cash within a year. So it includes things like, obviously, the checkbook balance, as well as things like inventory. Current liabilities are obligations due to be paid within a year. So it includes things like accounts payable, trade credit, operating lines of credit, as well as the current portion of long-term debt. A current ratio of 1 would mean that the business has current assets exactly equal to its current liabilities. A rule of thumb, since current assets includes inventory, is that for most businesses, you want this number to be at least 2, indicating that you have double the current assets as you have current liabilities. And we can see that for most years, except 2016, the Northeast dairy farm industry was able to meet that standard. The other ratio that's used in the orange bars is what's called the quick ratio. Since inventory in a dairy farm is mostly stored feed that's intended to be fed to the animals, it's not readily available to pay bills in the short term. The quick ratio, therefore, only looks at cash and other things that can be quickly converted to cash, such as stocks or other investments. A rule of thumb is that for most businesses, you want this number to be at least 1, indicating that you have enough cash to pay bills that are going to come due soon. If it drops below 1, that's a sign that the business is relying on money to come in the door in order to pay bills that are coming due. It means that farms may be holding bills, payroll, and other obligations, waiting for that milk check to come in order to cover their payments. We can see that in recent years, such as 16, 17, and 18, that's a situation that many dairy farms have found themselves in. So to summarize and give some takeaways from the dairy farm summary, in 2019, Northeast dairy farm profitability improved significantly, but it improved from a loss. And that improvement was largely due to increased milk prices, as well as farmers keeping costs under control. However, we continue to see a wide range of results, with farms' results coming in across the board, some doing quite well while others struggle. The average farm size, both in the region overall as well as in our sample, continues to grow. We again saw positive correlations between farm size and profitability, with larger farms tending to be more profitable. However, not all large farms did well, indicating that size is not a guarantee of success. Only about 1/3 of the farms with more than 700 cows made the top profit quartile, and some of those farms lost money. In general, most farms saw cash flow back to positive levels, but many farms are still recovering from prior years and their increased debt that they may have taken or holdover accounts payable that they may have had from prior years. Finally, between the COVID-19, the loss of food service markets, international trade disputes, and more, there is a great deal of uncertainty going forward. And I think that that's a great segue for me to hand things off to Bill Zweigbaum, who will present a mid-year outlook next. So with that, if we have any questions, Kyle, we can entertain one or two, and then we'll switch over to Bill.
Is Farm Credit East able to compare the DFS to other dairy regions, say Wisconsin or California or the Western?
Okay, that's a very good question. I'll talk about it a little bit. Our results are fairly consistent with what we see in the upper Midwest, like Wisconsin and Michigan, where the farm sizes are comparable as well as the business model. Most farms in the Northeast, as well as those in the upper Midwest, tend to own a substantial amount of land and grow a lot of their own feed, that they, at least the silage and forages that they feed their cows. Farms in the West Coast tend to have a pretty different business model. They tend to be a lot larger, and they tend to buy in most of their feed and own a lot less land. So those farms, their economics, they tend to be more boom and bust, the Western model, because they're buying more feed, so they're more susceptible to the ups and downs of the feed commodity markets. And they tend to expand and contract and see their profits go up and down accordingly. They also have pretty significant economies of scale. Farms in the Northeast and Upper Midwest tend to have a little bit less volatility because they're producing some of their own feed, and so a little less volatility there. Overall, they tend to be slightly less profitable than those on the West Coast.
Okay, so what I'm going to talk about today is a summary of where the first half of 2020 has been so far, and then I'm going to also talk about the outlook for the rest of the year and what we are anticipating to be the financial results for all of 2020. I'm going to give a little bit of a plug here for our Dairy Profit Analyzer program. It's a monthly budgeting tool that the consulting group uses with many farms. As of this week, we had 62 farms with financials included through June 30th for the first half of this year. And what I'm going to talk about are some generalizations based on that data, so that you have an idea of what we are seeing and also what we are anticipating as we budget through with this large group of dairies that participate in the program. Average milk income was $18.29 through the first 6 months of the year. Notice I call that income, not milk price, because it does also include hedging activity and revenue protection insurance along with the milk price. Average variable costs, $11.27, and average overhead costs of $5.22 in the first half of the year, giving us an average net margin thus far of $2.03. So what's changed since the first half of 2019? Well, milk income is about 35 cents higher. So again, remember that despite the fact that May and June were pretty poor milk price months, we started out the beginning of 2019 with strong milk prices. Milk chicks were quite large January, February, and March. And we also had CFAT payments that arrived in the first half of the year. That's the Coronavirus Food Assistance Program money that was come through USDA. It was approximately $1.25 of income in the first half of 2020. And we also expect an additional approximately 30 cents by the end of this month to come through. For a lot of our farms, dairy margin coverage paid out up to 66 cents, but it was capped by pounds of milk, so larger farms did not receive the full 66 cents. And then we also had a fair amount of farms that participate in dairy revenue protection, or DRP insurance, which paid out somewhere between 0 and 60 cents, depending on what the farm had done in terms of premiums paid for different time periods. Every farm, of course, has its own situation with its risk management tools. In addition, keep in mind that milk income was affected on some farms by excess milk-based programs that came into play from some of the milk handlers. Those programs were instituted early in the spring, and depending on who the marketing organization is, will determine how great of an impact that has on any individual farm. But we're certainly going to see larger variations between marketing organizations this year as opposed to previous years. The impacts will depend on the decisions that individual farmers made regarding decreasing production or not. Some farms have managed to bring production down to what their assigned base levels are. Other farms have not chosen to be that deep of a cut into their milk production. The other thing that is going to have a big impact this year, of course, is the risk management choices that individual farms have made, and of course the weather and specific milk handlers. We do have some regions, at least in New York State, where we've got fairly strong drought conditions that are going to impact both crop yields and crop quality. So on a per hundredweight basis, what are the general changes that we saw? Milk income, as I mentioned, was 35 cents higher for the first half of the year compared to 2019. Our crop expense and forage purchases were 20 cents a hundredweight lower. Keep in mind that crop expenses are mostly fully booked right now, as they have been in most years, so that we are going to see them diluted with a little more milk throughout the rest of the year. And the other piece of that is that forage purchases do likely increase in the fall after corn harvest. But we are comparing only first halves at this point, so all in all, a little bit better situation there. Grain purchases, purchased feed, 45 cents a hundredweight higher in the first half of 2020. That is largely due to the fact that we have had poor quality forages from last year that are impacting feed rations and increased the quantities of grain. And so when we look at the indexes of corn prices and soy prices, the first 6 months of 2020 actually are about 4.5% lower than the first half of 2019 in terms of commodity pricing. But again, grain quantities have had to be increased. Labor was only slightly higher, pennies. Milk marketing about a nickel higher. That includes some of the overbase charges that were included and the COVID penalties that were included. And then total variable expenses increased by about 40 cents a hundredweight compared to the prior year, 2.8%. So that's really mostly inflation that we're measuring there. All of those changes were completely offset by a non-milk income increase of $1.85. As I already mentioned, CFAP was about $1.25 of that. But additionally, we have seen more cull cows leaving the farms this spring, mostly due to the base programs and low prices, and some additional crop sales and miscellaneous activity to try and generate some extra cash flow. So basically, gross margin of that milk income minus the variable costs is up about $1.80 over the first half of 2019. And with overhead being very flat within pennies, the net margin is also up about $1.80. We did not include in this analysis the Paycheck Protection Program, the PPP funds. We treat them as extraordinary income. They were very variable due to farm-specific circumstances. But for most of our larger farms, averaged about 50 cents a hundredweight of additional cash flow. So in all reality, 2020, despite the pandemic, is likely to pan out to be the best year we've seen since 2014. Now, keep in mind that there's still many months left to this year, and we don't know what the pandemic and the general economy is going to do to dairy markets, but that's the best estimate we can make right now, looking at existing performance and the futures market for the rest of this year. So second half milk income will be anticipated to be about 30 cents lower because we did get that big CFAP payment in the first half of the year, with a full year average of probably in the $18 to $18.50 range for milk income. We are still in a period of very extreme milk price volatility. So, we need to keep in mind that things could change very rapidly if something else in the economy changes or something else in public health changes. Retail demand, food service demand, supply chain disruptions, inventory builds by wholesalers, export markets, the general recession and government policies are going to be big. And of course, whatever farmers do to influence the total supply is also going to have a very large influence on what's going on. Exports have been picking up very strongly. Mexico and China are our two biggest export customers. Mexico is in a general recession right now, with their GDP down about 10% and their unemployment rate almost doubled in the last 6 months. And China, while they've been good trade partners so far, they just closed a deal with New Zealand to reduce tariffs that had been in the 10 to 20% range, depending on the product sold. Now there are no tariffs, all at 0% between China importing from New Zealand. So that could have an impact on U.S. exports in the last half of the year. We may also see some possible additional direct assistance to ag in the next bill that's currently being worked on in Congress. The U.S. milk prices did have the biggest downward response to COVID of any country in the world. That may be due to the fact that we have more real-time data, or perhaps due to an impact of lockdown on food services and the American public's use of outside dining more so than a lot of other countries. Right now, internationally, what we're expecting is a kind of a V-shaped recovery, so a very rapid recovery for the dairy industry. Food service demand globally has recovered to about the 75% level. Retail demand has been very strong. And we expect that, the U.S. will probably do quite well this year. Although we did experience a 29% decrease in milk income in May, whereas most world markets only declined between 5 and 15%. But our recovery has been coming very fast. The other thing I want to point out here, Chris had spent a bit of time kind of running over net cost of production and how that's a very useful tool normally. In this particular year, it's not going to be the best indicator of profitability because of the extremely large non-milk income we had from exceptional government payments, along with revenue protection proceeds and a very wildly divergent milk pricing between milk handlers this year. So just a word of warning there that net cost of production may not really tell you how well you're going to do in terms of actual accrual profits for 2020. For the rest of the year, we think that high unemployment will keep pressure on wages to remain steady. First half of the year, labor costs were well controlled. As I mentioned, the grain cost index is down about 4.5% through June, and the futures market are giving us no indication of any upcoming increases of any magnitude. Local crops look like forages will be higher quality than 2019 for the most part, but there are some very localized areas that are going to have forage issues this year. Our fuel index for the first half of 2020 is down 13.9% over 2019, and crude oil is still sticking in the low $40 range. Today it's just a tad over $41. So fuel should stay low for us and hopefully carry through into crop harvest with some lower operating costs. Our full year expectations is going to be an average net margin in the range of $1.50 to $2.50. And we can't, say this enough. There are going to be specific circumstances for each farm that are going to play a very large role in determining profitability this year. So with that, we'll open it back up for questions again for both Chris and I, and then we will wrap up. Kyle, do we have any questions?
Yes. So the first one's for Chris in regards to the DFS. So you said there was a number of farms from New York this year. How does that compare to the rest of, say, New England in the type of operations and the size of operations?
Okay, that's actually a very good question. Historically, the Dairy Farm Summary has always had a majority of its farms from New York State, in like the 60 to 70% range, and then the balance from New England states. But this year, a couple of things happened that tilted that even more towards New York. One is that, as many of you know, the state of Vermont, half of New Hampshire, and a couple counties in New York State are serviced by Yankee Farm Credit. And over the years, we've generally collaborated with Yankee Farm Credit to include farms in their territory in the Dairy Farm Summary. This past year, we weren't able to because of some software issues that made it just impractical to merge their farms with ours. So that took out farms from Vermont, which is of course a heavy dairy state. So that reduced the number. And then the other thing that happened is many of our farm customers in the New England states just weren't able to get their financial records ready in time, even with the delay. When Vermont is included, the average size between New England and New York is actually remarkably similar. The distribution in New York is probably a little bit wider because we have some multiple thousand cow farm dairies in New York, particularly in the western part of the state. But we also have a large number of very small dairy farms, under 100 cows, particularly in the Amish and Mennonite communities that we include in the Dairy Farm Summary. So the average comes out actually remarkably similar between the two regions.
Question for you, Bill. When looking at the Dairy Farm Summary and then the farms that participate in the Dairy Profit Analyzer, and particularly the 62 farms that you had mentioned, how are those? Is there much comparison, and is it very similar and it kind of in line with the Dairy Farm Summary?
They do tend to run fairly in line. They tend to be a larger size, but again, I did not use actual Dairy Profit Analyzer data. I used it as a guideline and made generalizations about what we were seeing in terms of changes on farms. So I think they're pretty comparable in terms of what we're trying to do today.
Mm-hmm.
Hey, Kyle, let me just put in a little bit of explanation there as well for people that aren't familiar with all our benchmarking programs. The Dairy Farm Summary is a free program that's open to all dairy producers in the Northeast. And it basically just is limited to economic information. For farms that want a deeper dive, including looks at components, production metrics, things like that, we offer a program called our Success Strategies Benchmarks for Dairy. And that is a fee-based program where you do have to pay to be part of it, but it's a much deeper dive into operational metrics and that sort of thing. And you can reach out to us for more information if you'd like to be part of that.
I think this is more of a clarification question for you, Bill. When you talk about the cost of milk marketing, does that include the cost of some various risk management programs that some producers may use?
No, that would not. That would be actually included as an insurance premium. It would not be included in milk marketing costs. The milk marketing costs would be hauling, dues, fuel adjustment charges for hauling, any market adjustment fees, and then, of course, your CWT and your dairy promotion.
One thing that's interesting to me about the 2020, your comments about 2020, is that you mentioned that it may be a relatively good year, but that a lot of that is due to government support programs and COVID relief payments and things like that, rather than the milk price itself. And I'm sure that not all farms were able to access all of these programs equally. Do you think we'll see a wider distribution of results this year as a result of that?
I do, particularly because some of that milk income came from the Dairy Revenue Program, which is not as heavily used as we might like it to be. And of course, second quarter payments were much larger than any normal year that we see because of the precipitous drop in prices after the lockdown started. So yeah, we're going to see a lot of variability between people who made use of risk management and those who didn't. In a more quote unquote normal or typical year, the difference between risk management funds coming in and risk management premiums being paid is usually pennies per hundredweight, and this year it's going to be quite significant.
Chris or Bill, do you guys have any final thoughts before we close out the webinar?
I'll just wish everybody a safe summer, good harvest, and stay healthy.
I had one kind of thought or takeaway that I got from your presentation, Bill, and that is the importance of risk management as a truly as an insurance product. I think a lot of us or producers maybe perhaps look at the projected payouts and make their decisions based on the likelihood of the programs to pay out, and that's something to consider. Particularly because the programs are based on futures market prices, many of them. But it's important to realize that really what you're looking at is a risk management insurance product to protect against that black swan event. And I think we've never had a bigger one than we did this year. So it's really to protect from that unforeseen impact. And I think we really kind of learned that lesson a lot this year, and I hope we take that going forward.